Right, hello, and welcome everybody to today's webinar, Single Premium Life Insurance, 7 Reasons Clients Will Buy. My name is Brian Lysing. I am the Life Insurance Sales Director here at Financial Brokerage, and I'd like to welcome all of you and thank you for taking a few minutes out of your day to join us. If you're not familiar with Financial Brokerage, we are a national insurance marketing organization working with agents and advisors all around the country in the areas of life insurance, long-term care, annuities, disability income insurance, Medicare supplements, and critical illness. We've been at this since the mid-90s. I've been here since, I think, 2001, maybe '02, dealing with life insurance primarily for most of the time here. So today's webinar is going to focus on single premium life insurance. I'm going to cover 7 scenarios, and I think I may briefly touch on an 8th as well. Different reasons why your clients will purchase this product, things you want to look for when you're speaking to people. I'm going to be giving examples with each of these 7 scenarios as well. But first off, let's start with what is single premium life insurance. I'll simply put, it's a life insurance policy where your client pays one premium and that's it. The policy is paid up. They never need to pay another cent into this thing ever again. Now, this could be on a whole life chassis. It could be a UL. Oftentimes, it's an IUL type of product, but no further premiums are ever required. Now, that does do something a little different to the policies that usually makes them into modified endowment contracts. Now, that's not a bad word. It simply means that if your client takes any money out of the policy later, whether it's in the form of a withdrawal or a loan, the policy is treated the same for tax purposes as if they had a non-qualified annuity. That means the first money coming out is considered growth, if there was growth in the policy, and then that would be taxable as regular income. Now, the scenarios we're talking about today will not involve any money coming back out of these policies. They're simply going to be used for the death benefit, and the death benefit passes tax-free to the client's heirs. So we don't have to worry about whether these things are MECs or not. They will be, and it really doesn't matter for our purposes here. So let's get into the 7 different scenarios where you might consider this for your client. And I guess one other thing to note too, usually we think of these types of products as being for our wealthier clients. They have maybe 6 figures lying around that they don't need to live on in retirement. The money's going to be passed on to the next generations. All we're doing is putting it into a different place that would do that more efficiently. Well, not everybody has that kind of money lying around. I would say most middle Americans do not. And that's why most of these sales ideas are going to cover scenarios that would fit with middle America. You don't need to just look at your wealthiest clients to make these ideas work. So our first scenario for using single premium life, and this is something we don't think of, myself included, this could be looked at as a product that is a final expense policy, but with convenience. Well, what do I mean by that? Well, if you have a client that's looking for a final expense policy, and let's take a look at Judy here on the screen. She's 68. She wants to get a policy to cover her final expenses, her burial, her funeral. But, she's a little concerned about what happens if she becomes cognitively impaired. As she ages, she's afraid that she might forget to write that check every quarter or once a year. She might forget where her checkbook is at some point in time in her life. Or what if the bank messes up the automatic funds transfer, or she has to change banks? Or maybe her finances are being handled by her adult children at some point in time, and they don't know what she has in place. And they're looking at the statement. They're not sure where certain charges are coming from. If you've ever seen a bank statement, if you're trying to figure that out, it's a little hard sometimes, right? The name that appears in the statement is not necessarily the same name as the store or the entity or the insurance company that you know them as. So that could very easily happen. A premium is missed and discontinued, and then there goes the policy. Well, here's the convenience factor. Judy happens to have $10,000 in a CD right now. What could she do with that? Well, she was considering a final expense plan for $71 a month. That gives her $15,000 of death benefit. Well, if she instead moved that $10,000 in the CD, she could still have a $15,000 death benefit. And now she doesn't have to worry about anything ever again. The policy is just sitting there, essentially waiting for her to pass away. We don't have to worry about the bank funds being transferred or writing a check or remembering, and is the family going to know what she did? It has all been taken care of. Another thing to consider too, now I ran these numbers without looking into the time value of money, but let's say she pays $71 a month. At some point in time, she's going to pay in that $10,000 single premium equivalent. And when you crunch the numbers, that works out to be 12 years from now, she'll be 80. Well, if she lives to age 85 to age 90, that traditional final expense plan is going to cost her more money overall than if she had just paid the $10,000 all at once. And again, I did not do the time value of money calculations, but at some point there will be a crossover even if you take that into consideration. So convenience is one reason to consider a single premium life policy. Another reason your clients might want to look at this is if they're considering going to their local funeral home and paying for a prepaid funeral. People do this all the time. They want to lock in today's prices, thinking that they're not going to pass away for another 10, 20, or 30 years. On top of that, their family doesn't have to worry about any of the planning issues. They don't have to worry about coming up with the funds because they've taken care of it themselves, right? Well, is that a good idea? Well, maybe, but there are some drawbacks that maybe a single premium life policy could take care of. So let's look at George here. He's shopping for a casket with his wife, or maybe for his wife, who knows. But he's thinking of purchasing one of these prepaid funerals at the local funeral home, right? He doesn't want to be a burden to his family, doesn't want them to have to deal with this later on. Well, if he does that, and I just pulled a number out here, let's say George writes the funeral home a check for $15,000. Okay. Whatever the funeral is going to cost in the future, it's taken care of with today's dollars, but he's locked into one location. Now, how many seniors stay in the same place for their entire retirement years? I mean, some do, right? But there are plenty that will move somewhere else because the weather is a little better. They're moving to Florida. They're moving to Texas. They're moving to Arizona and away from places like Boston or Chicago or who knows, right? Some of the colder places around the country. All right, are they going to ship the body back north? Maybe, but I don't know. What if their adult children have decided to move and have careers and have their grandchildren in other parts of the country? Sometimes they want to be closer to their family members that have moved away. They don't want to be locked into one location for this. So in George's case, if he instead paid that same $15,000 to a life insurance company, the scenario I ran, he'd have an $18,000 death benefit. Again, he gets some leverage on the money, but he has flexibility. It doesn't matter where he's at when he passes away. Everything is still taken care of. It's his choice and his family's choice what happens at that point in time. So scenario number 3, you might have clients like this where they already have some permanent life insurance in place, and they've had it in place for a while. In fact, let's take a look at Mark. He purchased a $350,000 UL 25 years ago, and Mark was about 39, 40 years old at the time, and he's been paying $250 a month into this thing. It's built up some nice cash value, but he's gotten to the point now where the cost of insurance charges are greater. He can see in the projection that they're soon going to be greater than the money he's paying in and the interest being earned on that. So his cash value is going to start to decline. We've all seen older policy statements like this before, where the insured is now concerned about are they going to outlast their coverage, right? So we've caught this policy early enough. Mark has got $48,000 in his policy right now. It looks like this is probably the high point of cash value for this policy because the projections show that amount declining. So Mark would like to lock in that money, and he's at a point now where he doesn't need the entire $350,000 of coverage. So some things Mark could do, depending on his policy, he might be able to take a reduced paid up option. He could just talk to the insurance company and say, hey, how much coverage can you give me if I stop paying premiums? And, what smaller amount would be left? Well, Mark looked into that. In this case, if he stopped paying premiums, the policy would still lapse before age 80. So that's not an option for him. You might have a person with another scenario where their policy is old enough, it doesn't have a no lapse guarantee provision in it. And it's relying just on the cash value to stay in force. At interest rates from 25 or 30 years ago, it ran fine, but not at today's interest rates. So what can we do to help people in this situation? Well, we can help them get a new policy and fund it with a 1035 exchange. Now, 1035 exchange is just describing the tax code that says you can move cash value from one life insurance policy to another policy without any adverse tax consequences, without having to pay taxes on that. So in Mark's case, he's got $48,000 in the old UL. He's going to move it this time into a single premium whole life policy, and it's going to give him about $25,000 of leverage. He's not going to have to worry about this ever again. He knows that policy is just sitting there, again, waiting for him to pass on, and he doesn't have to worry about the cash value decreasing inside that policy. And incidentally, I want to thank our friends at Assurity Life. They're one of the life insurance companies that we work with here at Financial Brokerage. When they rolled out their new single premium whole life policy, they had a whole series of sales ideas that came with that. Several of those that you see in this webinar were taken directly from Assurity, and I'm referencing their product in some of these. That's not the only one that we have available here, but they brought the ideas to my attention. So moving on to scenario number 4. What if you have a client who's downsizing and they've sold a home, they're purchasing another one, it's not quite as big, but they've got some extra money from the sale of that home, right? Well, let's take a look at Earl. He's 67, just retired, and he did exactly that. He sold his former home for $500,000. His kids have grown and moved out, started families of their own. He's concerned about stairs in his house. He's got 2 stories. He's got a basement. He thinks, maybe 20 years from now, I won't be able to navigate those stairs quite so well as I can now. He wants to move to something that's a little more convenient, doesn't have as many bedrooms that aren't being used. So he's going to purchase a townhome for $200,000. Well, now he's got an extra $300,000 laying around. He really didn't need this for retirement because he already had his retirement funds taken care of. Well, what if we just take a part of that, right? We don't need the whole $300,000. What if we just take $100,000 and move that in this case into a single premium whole life policy? He can get $41,000 of leverage out of that money that he wasn't really using anyway. It wasn't earmarked for anything. Meanwhile, he still got the extra $200,000 to go out there and have fun with or do whatever he wants. So that's another scenario to look for, somebody who has sold a larger home that they no longer need and have downsized. All right, scenario number 5. This is what I would usually think of as the typical scenario for single premium life. We're looking at a wealth transfer type of situation. A person has money they don't need to live on in retirement. It's already earmarked to go to the next generation, but it's probably not sitting in the right place. It's in the bank. And in Brenda's case here on the screen, she was only earning 0.85% interest. She got this interest rate locked in before interest rates went up. Now, this doesn't mean that you have to have a client with 50 grand, 100 grand, 200 grand to do this. Brenda just has 17 grand in the CD. Doesn't need the money to live on. But what would happen if she put that into a single premium life insurance policy? And we're going to see here that she could turn that into a $27,000 death benefit. Now, at the interest rate that she was getting at the bank, I ran the numbers earlier, and actually, I think they were on the previous screen. Here we go. It would take Brenda 50 years, right? She could leave her 17 grand in the bank for the next 50 years before she ever hit $27,000 after tax. I don't know about you, but Brenda's 65. I don't think she has 50 years of life expectancy left. That would make her 115, according to my math here. I don't think Brenda's going to make it that far. So the life insurance policy is a much better place to put those funds as opposed to leaving them in the bank. And before I go on to the grandchildren, I probably could have turned this webinar into 8 reasons for single premium life. I didn't want to complicate it too much by talking about long-term care, but I think that would fit well with this wealth transfer situation. Many of these policies have a chronic illness or an LTC rider. Some are designed specifically with long-term care in mind, so the person can move assets and get 2 or 3 times the leverage out of those as a pool of money for long-term care purposes, along with the death benefit if they don't use the LTC. But I really felt that was probably a separate webinar in and of itself, so I'm not going to go into that in any more depth here. But scenario number 6, a gift to grandchildren. You know, I get a call for a scenario like this. I would say every month somebody will call me and say, Brian, I've got a couple or maybe just one grandparent, and they want to purchase life insurance policies on all 5 grandkids or all 10 or all 6 or what have you. Well, that's great, but there are some problems with that. You know, first of all, the person purchasing the policy is usually about 70, 75 years old, and they're buying a policy on a 5-year-old. Well, are they still going to be paying the premiums when that 5-year-old is 20, when they're 25, when they're 30? Who's going to take over the policy? There's no guarantee that the kids or their parents are responsible enough to do it. In fact, maybe they aren't, because that's why grandma and grandpa are doing this in the first place, right? Their children weren't responsible enough to do it, or they don't have the funds to do it, or they don't trust them to do the right thing with the funds. So we have a problem there. Are the policies still going to be in force well into the future? Well, then we can start looking at a single premium life policy, and just so happens the sureties product here works very well in these cases. So we're looking in this case at Joe and Mary. They've got 3 grandchildren. They all happen to be age 5, and they'd like to pass on more than just toys and electronics to those kids. So again, we get this all the time, and in this case, they've got $15,000 that they want to use to pass on. Well, they can take $5,000 for each grandchild, put that into a single premium life policy on each grandchild's life. That gives them $57,000 coverage each. That's a sizable amount. And great thing is they don't have to do anything else. They don't have to pay another premium. And on top of that, you know, the death benefit, the grandkids would have a little bit of money in there. Might pay for books for 1 or 2 semesters in college, but there is some cash that they could dip into if they need to. But now grandma and grandpa have the peace of mind that all of these grandkids have a policy, and they'll be remembered because they're the ones that purchased that and gave it to those grandchildren. All right, scenario number 7. And this one, I would guess, is going to be let's put it this way, the least likely to be used, and that's for Medicaid spend down. So some states will exempt permanent life insurance policies from their Medicaid spend down calculations. Now, you could accelerate your spend down, right, by spending more money, and one of those places you could spend your money could be a permanent life insurance policy. Now, the downside to this is most states only allow an extremely low face amount of coverage to qualify, $1,500. So if you're in 45 states, just forget about this idea completely. It's not going to work. However, there are 5 states I found that allow up to a $10,000 face amount policy, and that could very well be funded with a single premium, so it would help them with their spend down, and then they have some leverage on that money to pass on. So if you are in the states of North Carolina, South Carolina, Mississippi, Louisiana, or North Dakota, this idea could work for some of your clients as well. All right, so right before we wrap it up, I want to give a quick recap of the 7 markets for single premium life insurance that we covered today. One is looking at it as a final expense alternative, one that gives clients a lot more convenience than having to continue to pay premiums month after month, year after year, at a time when they may be cognitively declining and maybe unable to read their bank statements at some point in time. Single premium life is a great alternative to a prepaid funeral plan. It still gives your clients leverage. With those dollars, they're going to end up with more than what they put in as far as value, and they're going to have the flexibility of having their funeral wherever they want it to be, wherever they happen to be at the time that happens. We could also look at this in a 1035 exchange policy. If your client has an older permanent policy that's just not performing as expected, or maybe has served its purpose and they don't need that same sort of product anymore. Maybe your clients are downsizing. They've sold a home and purchased a smaller one. They have some extra money. That dovetails right into a wealth transfer situation where they have funds that they don't need to live on in retirement. And again, it doesn't have to be a 6-figure fund. It could be a 5-figure number that's earning next to nothing in their local bank. They could be looking to give gifts to their grandchildren, or in some states they could be looking to use this to help with the Medicaid spend down scenario. So those are the 7 markets right there. And as far as products we might use here at Financial Brokerage, I know I mentioned Surety's Whole Life. They're not the only one we work with that has a single premium whole life. There are a handful of companies. And then in some scenarios, we may look at an index life policy that is specifically meant for wealth transfer type of situations. I didn't want to go into those and list them all because products come and go. What we have available today may not be around 6 months from now. Another company may come along. Depending on your client's age and the amount of money going in and their health, one might be better suited than another. You could have a husband and wife where we're looking at one company and one product for one and another one for the other for all of those reasons. So the best thing you can do is search for those scenarios within your existing client files and then call us at Financial Brokerage. Give us a description of your client's situation, and we can help find the best product that would fit in their case. So I'm going to go ahead and open it up for questions, but I do want to thank everybody for joining us today on the webinar, and yeah, thank you very much.